I'd like to ask you about financial regulation. Can you tell me, do you think the implementation of the DoddFrank rules are likely to drive up transaction costs for foreign exchange trading?
Actually, on the contrary, there are elements of Dodd-Frank that I believe are going to help the market, and certainly in the area of derivatives, and they're trying to bring derivatives trading away from a fragmented OTC market structure and to bring them to exchanges. And I think that will ultimately drive down transactions costs and create more transparency in the market. So I actually think that will be constructive for the market.
And how big a deal is the cost of transaction for you at FX Concepts?
Oh, it's actually quite significant. As you know, we're an alternative investment manager, and we trade strategies on behalf of our clients, largely pension funds. And depending on the frequency of our strategies, transactions costs can be anywhere from 15 to 100% of our expected profits. So it's quite significant for the success of our ultimate end users and investors, which are pensioners.
Okay, thank you. Tell me about your view on the dollar over a 1-year horizon. Do you see it rebounding from the current weakness?
Well, ironically, yes, but not necessarily for constructive reasons. We are very concerned about global growth, and especially growth in developed economies, simply because all the policy interventions that were deployed in the aftermath of the Lehman or the subprime crisis have already been tapped out. You can't get interest rates lower than 0%. You might have subsequent rounds of quantitative easing, but again, you can't. It's really difficult to imagine monetary policy becoming any more expansionary or supportive. We've tapped out fiscal policy. We pretty much were out of bullets. And that being said, we remain in a very high-risk environment. And there are many elements and risks on the horizon, including the debt crisis in Europe, high energy costs, and a number of other things that make us feel that another recession or another downturn in the rate of growth is very likely. As it turns out, during periods of international or even domestic recession, the dollar tends to rise because banks who provide ultimately dollar liquidity for the market tend to contract their balance sheets in reaction to the higher risk. So we believe that the negative outlook for growth, especially in early 2012, is naturally going to be a boost for the dollar. And as risk assets become more, less attractive, and we get rumblings in the financial markets ahead of that slowdown, the dollar will naturally, in our opinion, appreciate.
So the key here is timing.
I think the timing in the very near run, at least within the horizon of about a month, say, we do think that risk assets or equities, commodities, and the like are likely to trade well, and it's risk on. But as we get further into the summer, the environment looks a little bit riskier to us.
And tell me about your view on the euro, and in particular the Greek debt crisis. Where do we go from here? Do you see a resolution anytime soon?
We don't see a resolution. And again, to be clear, the problem with the euro and with the eurozone in general is it's unfinished business, and I think the Europeans recognize that as such. So the unfinished business is they need to have a unified fiscal policy, or a fiscal union, so to speak, throughout Europe, and that's undone business. So it's really a problem of social choice. The Mediterranean economies, and especially the Greeks, are not sustainable within the euro. And oddly enough, because we are talking about the Greek debt, in my opinion, the Greek debt is largely inconsequential. It's much too big for the Greeks ever to pay by themselves. Nevertheless, it's quite small for the French, the Dutch, the Germans, and the Northern Europeans to divide among themselves and cover for the Greeks. The sticking point is, are they willing to step forward and provide an ongoing fiscal transfer to the Greeks to allow the Greeks to live sustainably within more or less the current economic structure they have within the euro? And the debate is, how much restructuring are we going to demand of the Greeks in order to give them fiscal transfers on an ongoing basis? And the politics of that are quite tricky. And again, that's a blueprint for the rest of Europe. So I do think that that's a political problem, and it's going to take longer than a month, a quarter, or even a year to ultimately work out. And there's going to be a lot of financial volatility as the markets bet whether they get it worked out or not. And of course, if they don't get it worked out, we do think that it will be bad for, certainly run the risk of a banking crisis and certainly hurt the euro if ultimately they can't find a political solution to the fiscal unification of the continent.
Mm-hmm. And over the 12 months coming up, that makes you want to stay clear of the euro, or?
Well, it creates a lot of volatility. As we like to say, the euro could either be, the value of the euro should either be at 180 or at 80. So the 180 is the German euro and 80 is the Greek euro. And it's going to be going back and forth between those two extremes as the probabilities ultimately for rational or orderly fiscal union of Europe, as that probability rises, the euro will rise. But as the potential for failure of that political process, and the first round of failure, the first consequence of failure, is probably a banking crisis within the core European banks. As that gets higher, the euro is going to trade off.
I wonder if I could also ask you about the currency wars that we saw in the emerging markets in the past year. Was this a one-off phenomenon, or is it going to be an ongoing battle for the emerging market economies?
Well, firstly, I think of the idea of a currency war, that terminology, as being a bit of a misnomer. Now, certainly, politicians sometimes need to deflect concern or deflect attention onto external factors and things that they don't control themselves. And currencies are a natural candidate for this sort of thing. In the United States, we like to complain about the renminbi. In Brazil, they like to complain about the dollar. And in many emerging market economies lately, they like to complain about the dollar. Nevertheless, the valuation of the dollar in international markets really is a consequence of a monetary policy being pursued by the Fed. And so the monetary transmission mechanism is, I think fairly obvious. If the Fed's aggressive policy has led to a recovery in U.S. asset markets and the world looks safe for risk, that by consequence, as a consequence, makes the dollar weaker. In addition, we have zero rates in the United States and expanding monetary base. That also makes the dollar weak. That's inevitable. But I don't think most people are doubting that, at least in the short run, the necessity and the effectiveness of the Fed's monetary policy in reaction to a deep crisis. So what are you going to do if you're Brazil and you don't want your currency to rise? Well, you complain about the dollar. But ultimately, there's not much the Brazilians can do. They need either to import inflation because they import an inappropriate monetary policy from the U.S., or they let their currency appreciate, and ultimately their currency has appreciated. It's an inevitability. It's not really a war.
Okay, great to get those views. And also, tell me a little bit more about your views on China and the prospects for the renminbi becoming a more important currency in international FX trading.
Well, obviously, since in the 1950s, the U.S. was 60% of global output as it was measured back then, and the size of the U.S. economy has probably fallen to 24% of the global economy. And simply because emerging economies are growing so much faster, especially China and India, the U.S. share of global economic output is going to shrink. If you add on top of that a very loose monetary policy and the subsequent volatility in the dollar due to the reaction of the crisis, you have to ask yourself, is the dollar the appropriate vehicle for international payments? And it's natural to doubt it, and it's natural to say it should maybe perhaps the dollar does not deserve its preeminence. But then the problem becomes, what's the alternative? And so if it becomes a derby of what's the biggest economy out there, I think that's not the right measure for finding the next candidate or the next vehicle for international payments. And it's often overlooked, but the U.S. has very, very deep and very large capital markets. And if the globe is going to use a currency as the vehicle for international payments, there has to be a natural pool of very liquid and very efficient asset markets with which to invest in, if for no other reason, as a holding vehicle for the sums that you have in dollar to affect other transactions. And frankly, China just is decades away from having that status. And the list is manifold. Firstly, you have to have courts and a strong rule of law, and a non-political judicial process that international investors trust in as your first requirement for status as an international reserve currency. The Chinese are just decades away from this. Then you have to have a free and open capital account. Now the Chinese are working towards that, but it's going to take them years to open their capital account freely. So the renminbi is not even a fully convertible currency. So I mean, I could go on, and the list is quite long. But the qualifications for international reserve currency are long and difficult to achieve, and the Chinese, I think, are decades away from achieving that.